Hi everyone, I hope you all are doing well and welcome back to my channel Key Differences. I am Surbhi and today I am going to talk about the difference between profit maximization and wealth maximization. So without further ado, let's dive right into our video. Financial management. As the name itself suggests, financial management is the management of finance of the company. It is a managerial activity related to acquiring, financing, and managing the funds to attain the goal of the enterprise. It refers to forecasting, planning, organizing, directing, controlling, and coordination of the financial activities concerned with procurement and deployment of the funds of the firm. Come, let us understand this definition with the help of a diagram. Financial management involves planning, organizing, directing, controlling of the financial activities related to arrangement or procurement of funds and application of funds to achieve the objectives of the organization. Now, what are these objectives? Basically, there are two objectives of financial management: profit maximization and wealth maximization. Now we are going to understand these two objectives in detail. Profit maximization. To understand the concept of profit maximization, let us first understand the meaning of profit. Profit is basically the financial gain, that is, the amount which is left after deducting all the expenses and cost of inputs from the total revenue earned. Therefore, profit is the difference between total revenue and total cost. Now, what is profit maximization? Profit maximization is the process through which the firm ascertains the level of input, output, and price that results in highest profit. In specific terms, all the decisions taken by the finance manager relating to investment, financing, and dividend policy are oriented towards maximization of profit. Hence, while considering various alternatives, it is evaluated that if it maximizes the profit or not. Further, as per the classical economist, profit maximization is the appropriate measure to evaluate the operational efficiency of the firm. They are of the view that profitability maximization serves as a guide to financial decision making. It provides the benchmark by which the economic performance of the firm can be measured. It results in optimum utilization of resources because resources are allocated to the activities which are highly profitable to the firm. However, profit maximization cannot be the only objective of the firm because if the company gives excessive stress on the profit maximization, it may lead to a number of problems. So this criterion has been questioned and criticized on various grounds, such as the term profit is vague. This means that it is perceived differently by different people. That is, it can be short-term profit or long-term profit, gross profit, net profit or rate of profit, before tax or after tax profit. Next, direct relationship between risk and profit. It is a well-known fact that the higher the risk, the higher will be the profit. And so, a number of proposals with considerably high risk often yield high profits. So, the finance manager can overlook the risk factor if profit maximization is sole objective of the firm. But practically, risk factor plays a crucial role and which must be balanced with profit. Third, ignores time pattern of returns. Let us understand this with the help of a simple example. Suppose there are two projects alpha and beta, wherein project alpha may provide higher return in comparison to project beta. So even if returns of project alpha streams 10 years later, project beta may be selected regardless of the lower returns because the flow of return would be prompt and untimely. Exploitation of consumers, workers and employees. As the name itself clarifies, if the company gives too much importance to profit maximization, then there are very high chances that the management will put undue pressure on the workers and employees on reaching the targets, as well as it will also charge high price for its products and services from the consumers, leading to unfair and unethical trade practices. Ignores social considerations. Profit maximization as an objective fails to consider social element as it overlooks the obligation towards the interest of workers, consumers and society. It also fails to comply corporate social responsibility and corporate governance. Further, if these considerations are not fulfilled, it won't be possible for the company to survive in the long run. Wealth maximization. The alternative to profit maximization is wealth maximization. Now, before starting the concept, let us understand the meaning of wealth. Wealth, in simple words, is the value of all the assets which a person, company, or country owns. So, one can calculate wealth of the company by multiplying the total number of equity shares with the market price per share. Or it can also be calculated by adding the total market value of all the tangible and intangible assets of the company and then deducting the debts and liabilities. So after understanding the meaning of wealth, we will go through the concept of wealth maximization. For a company, wealth is equal to the value of the firm's equity, and so the fluctuations in the market price of the equity shares decides its wealth or value. It is based on the overall performance of the firm and the soundness of the firm's decisions as to investment, finance and dividend. Wealth maximization is a process through which a firm makes efforts to increase the value of its business so as to increase the market value of its shares. It is often reflected in an increase in the price of the company's shares, which ultimately increase its market capitalization. So, the shareholders can measure it in terms of the increase in earnings per share. Further, wealth maximization is beneficial to all the interested parties such as creditors, shareholders, employees, management, etc. From the point of view of the creditors, any increase in the company's wealth provide them extra protection concerning the interest and repayment of loan. Moreover, as far as the firm's employees are concerned, their interest is better served when there is a rise in overall wealth of the company. Now we will discuss the advantages of wealth maximization. Increase in the wealth of the shareholders. The value of the equity depends directly on the amount of wealth creation. The larger the wealth creation, the greater the market value of equity shares, which ultimately adds to the wealth of the shareholders. Considers time and risk factor. The time factor has two components, cash flow and timing of cash flow. Wealth maximization considers both the components, wherein cash flow refers to the funds available for use, while the timing of cash flow can be understood as the cash received today will be more valuable in comparison to the equal amount received after 1 year. Further, in wealth maximization, the risk factor is always taken into account while taking decisions for future, and the future is uncertain. Basically, risk is the absence of certainty. Hence, whatever decision a company makes, it considers the existence of risk. Optimum allocation of resources. When the objective of the firm is wealth maximization, the company adheres to all the policies and principles that would increase the market value of its shares ethically and morally. And for this, the company makes best possible utilization of its resources. Emphasizes on long-term returns. Wealth maximization is a long-run concept, which means that shareholders' wealth maximization is the long-term goal of the enterprise, because shareholders are interested in both present and future profits of the company. Considers economic interest of the society. As we have discussed earlier, wealth maximization is not just beneficial to shareholders as their overall wealth of the company is increased, rather it is also beneficial to the creditors as their debt gets secured when the financial position of the company gets better. Similarly, employees are paid better with the increase in the wealth. Moreover, the firm's wealth is a part of society's wealth, and so when the firm's wealth is maximized, the positive effects can be seen in the overall development of the society. Come, let's understand the difference between profit maximization and wealth maximization. Profit maximization is an economic assumption in which the firm seeks to maximize its profit. That is, in profit maximization, the main objective of the concern is to earn larger amounts of profit. On the other hand, wealth maximization is an economic assumption wherein the firm seeks to maximize the value of its shareholders' wealth, which can be reflected in the market price of the shares and earning per share. Next, while profit maximization is a single period or say short-term objective of the firm. Wealth maximization is a long-term objective. This means that profit maximization as an objective is for a given period of time only, but wealth maximization is a long-term objective as shareholders are interested in future as well as present profits of the company. Next, risk and uncertainty. Another reason for the preferability of wealth maximization over profit maximization is that it considers risk and uncertainty, whereas the same is not considered in case of profit maximization. As per profit maximization, the higher the risk, the greater will be the profit. And so, the decisions are taken without considering the risk factor. But in case of wealth maximization, all the decisions are taken after calculating the overall risk so as to ensure certainty in dealings. Next, one more element which distinguishes the two objectives is the time value of money. While wealth maximization takes into account the time value of money, profit maximization ignores the same. Next, profit maximization as the sole objective of the firm may lead to exploitation of workers, employees and customers. Further, it may also result in unethical and unfair trade practices which the firm may indulge in so as to earn higher amounts of profit. On the other hand, wealth maximization as an objective serves the interest of stakeholders, that is creditors, suppliers, employees, debtors and society at large. Next, in profit maximization, it is easy to ascertain the relationship between financial decisions and profit. But in case of wealth maximization, it is difficult to ascertain the relationship between financial decision and stock price. So guys, this brings me to the end of this lesson. I hope the concepts have been cleared from today's lesson. However, if you want to study the topic further in detail, you can visit our official website, that is keydifferences.com. Here you can find a comparison between profit maximization and wealth maximization along with their definitions. Links are also provided in the description box below. I hope you liked this video, and if you did, please do give it a thumbs up, and if you are new here, do subscribe to this channel and also hit the notification bell next to the subscribe button so that you are notified every time whenever a new video is uploaded. And if you have any queries or feedback for me, feel free to leave in the comment section below. Until next time, this is me Surbi signing off.